Are you closer to setting up a platform for retail investors here?
With some of the changes, it looks like there may be a path to doing retail mutual funds, depending on which way, how things get interpreted and so forth. So we're staying very close to that. I actually think, and again, this is why being here is so important, there's a lot of interesting things going on in the fintech space just broadly.
Talking about fintech then, do you see the likes of Alibaba, do you see the likes of Tencent as competitors to the Vanguard model?
I think they could be potentially, but I also think they could be potential opportunities for us as well. I mean, we certainly have paid a lot of attention to the Alibaba phenomenon and what they were able to do. Again, it's kind of a green field for the team right now, and they're out there talking to everybody.
In Asia as the region, they're lagging when it comes to passive fund investing. Is that a challenge for Vanguard's growth in the region, or does it mean that you focus more on the active funds?
So I'm not sure yet, but I think what it means to us is there is a lot of opportunity for what I would call low-cost investing. There's still a lot of very high-cost product in the Asian market, and whether it's passive or low-cost active, I think you can make a case for both. So it's likely you'll see us doing both over time.
The likes of Fidelity, for example, are starting to push back and lowering their fees, becoming more competitive. What changes are you seeing in the fund management industry?
So I think, for the first time, there's widespread belief that price actually matters, and there's a couple of things driving that. One is certainly our success, BlackRock's success in the ETF space. People aren't coming to us just because we're lower cost. They're coming because the net return to the investor is better, and that's really the whole driver, the cost argument. And I think people have actually awakened to this. I mean, the data are overwhelming, and you just can't charge. If you're an active fund and you charge 100 basis points, you have very little, very low probability of outperforming over the long run. Money management has been a very lucrative profession for active managers, and it's just going to get less lucrative. And I don't know what to say about that, except people have got to reinvent themselves. They've got to get smarter about how they actually run money.
There are the skeptics out there who say that this huge embrace of passive investing poses a significant risk to the markets. How do you defend against that?
The data just don't support it. I mean, what passive investing has provided the everyday investor is just better returns in a risk-controlled way. If you think about it, it's a zero-sum game at the end of the day. It all has to add up to the market. So the only difference in returns is cost. I think the cost differential is really the only thing that's driving, the growth of indexing. And that was not always the case, and that's not the case in every market. Now, there are markets where there's big retail presence, where the retail investor owns a huge part of the equity market overall, some of the Asian markets certainly. Active managers will do really well in those markets, in particular if they're low cost, because it's not a zero-sum game. The source of alpha, if you will come from those irrational retail investors. I would also say to the skeptics that because index providers are long-term in nature and long-term in outlook, it's much better for the economy and much better for corporate governance. So I actually think it reduces the risk in the system rather than increases it.